Okay, part three here, where we last left our heroes of King Company acquiring 80% controlling interest of Pawn. We went through this explanation of information given to us and deciphered it to understand how we come away with 20,000 goodwill to the controlling interest, 5,000 goodwill to the non-controlling interest under the facts and circumstances given for this problem or this example. So final information given to us is the fact that the date of acquisition here is January 1, 2014. Hope I didn't get you nauseous with that switch of slides. There we go, a little smoother there. And we're given some further information. The only way we know this is we would learn it from the balance sheets. And what it's showing you is that one of the things you can do is you can work backwards from information given to you as of December 31, 2015. You can work backwards and figure out the pawn company's opening 2015 retained earnings. You can figure out the increase in retained earnings from the prior year. This is information that is helpful to us if we need to answer certain questions about the consolidated financials that we can work backwards or forwards, as the case may be, easily enough to know more about the numbers. I think that's the main purpose of that slide, because it's not anything that we would know how to do on our own, because we haven't even been shown the 2015 balance sheets for Pawn and its parent company, King. King's use the equity method, so the consolidation process is exactly the same as we've learned in the past, with the added complication, not terrible, but the added complication of accounting for the non-controlling interest in the subsidiary. And this gives us an example of the worksheet that we might see at December 31, giving us in full glory this is what we call this a trial balance, I suppose, because it's all the accounts, or it's all the accounts just laid out in the form of the statements that they will become, the income statement, the statement of retained earnings, and the balance sheet. Just moving forward, here are the entries. You should go through these and test your knowledge of consolidation, knowing again that you're consolidating at 100%. And when you do so, what's going to happen is that you are going to wind up undoing the equity method of the parent. Notice in consolidation entry S, you're going to undo the investment account of the parent, but it's 80% because the parent's equity method, thinking back to the equity method, recorded everything at 80%. So you're only undoing the investment account to the tune of 80%. The other part that balances the entry is the non-controlling interest in Pawn Company. And this will be easier to see when we get to the actual spreadsheet and go over this. So hopefully that'll be one of the things we'll do. For now, I would just ask you to look through the entries and see how they work. For example, consolidation entry A. Again, we need to show the trademarks at their full consolidated balance. There's been no amortization, so there's been no impairment that we know of. So that's simply a debit $60,000 to put it on the balance sheet of the consolidated financial statements. We knew that from the information given to us way back yonder, that's the difference. The patent technologies is now being put on at net of 1 year's amortization. The liabilities net of 1 year's amortization there. Goodwill, no impairment, so that's just being put on. All those debits are putting the consolidated King's balances and Pawn's balances have to be adjusted for the consolidated book up at the date of the acquisition. So this is booking those assets and liabilities to where they need to be. The liabilities are being booked down because it's a debit to the liabilities. The equipment is being booked down because its value was lower than the book value. And notice that the investment account is credited for 80% of this entry, the difference going to the non-controlling interest, which will eventually be the non-controlling interest at the beginning of the year. So everything's being shown at 100%. And in order to balance, if the investment account on the parent's only at 80%, in order to balance, we've got to have the plug to the non-controlling interest. That's really what happens in this entry. And the first entry we looked at, the plug to balance, since everything is being booked to 100%, but the investment account is only representing 80%, the plug is to the non-controlling interest. And here we go with the additional consolidation entries, which I think I'll let you look through. I think you should be familiar with these. And what I wanted to get through is to see what the goal looks like. I like to sometimes, not sometimes, many times it's good to know what the goal is. And let's look at the goal, how the income statement should look when we're done. We're going to have a consolidated net income representing the entire company. And then we're going to break that down between the non-controlling interest share of the consolidated net income, which will represent the non-controlling interest share of the subsidiary's net income after the adjustments for the excess amortizations. King Company's controlling interest will represent its own net income plus its 80% share of the subsidiary after adjustments for amortization. So these numbers you could prove if you're using the trial balance that we saw before. Then you're going to have a statement in changes in owner's equity. And notice that you'll have the retained earnings, which will be that of the parent, the net income of the consolidation that belongs to the parent, less the dividends the parent paid to its shareholders, giving it its ending retained earnings. Common stock is of the parent only, and the retained earnings, so to speak, of the non-controlling interest in the consolidated financial statement represents the opening January 1, 2015 non-controlling interest retained earnings, so to speak, or equity. Retained earnings is probably not a good description. It's better to describe it as the non-controlling interest of equity. And then we add, like we do with other retained earnings statements, we add the income that belongs to the non-controlling interest. You see that up here. Take out the dividends paid to the non-controlling interest shareholders, and we end up with the ending equity portion of the consolidated financial statement belonging to the non-controlling interest. On the balance sheet, it looks like this. We show the non-controlling interest as a separate component of the equity. The retained earnings, thus, is the ending retained earnings of the parent. And that's a proof. When you get to your spreadsheets, the ending retained earnings of the parent will equal the ending retained earnings of the consolidated financial statement if we've done our work correctly. Okay, I think that will hold here. This is as good a place as any, and I'll see about whether we'll continue this through the break week or if we'll just pick up here on Tuesday, first Tuesday back after the break.